Hello, everyone. In our previous session, we looked at, how the government plans its spending. Today, we are going to focus on what happens when the spending doesn't match tax revenue. To understand our national finance, we must distinguish between, three stages of the, annual budget. The annual budget deficit or surplus is simply the difference between the tax revenue collected and what the government spent over a single fiscal year. A budget deficit occurs when the federal government spends more money than it receives in taxes in a given year. Conversely, a budget surplus happens when the government receives more in taxes than it spends. A balanced budget is the rare middle ground when spending and taxes are exactly the same. Historically, the U.S. government has, operated, in a state of budget deficits for many decades. This graph illustrates the relationship between spending and revenue. When the blue line for spending is above the pink line for tax receipt, the gap between them represent, the budget deficit. And the pink line is on top. That gap is a surplus. You can see the noticeable shifts during economic crisis. For example, the recession starting in late 2007 led to higher spending and lower tax collection, creating a massive deficit in 2008. An even more extreme version of this occurred in 2020 during the global pandemic. It is common to hear the terms deficit and debt used interchangeably, but they are very different concepts. The budget deficit is a flow measure over time, looking at 1 year at a time. The national debt is a stock measure, the total accumulated amount that the government has borrowed over our entire history and has not yet paid back. Effectively, the national debt is the dollar value of all outstanding treasury bonds the government currently owes money on. Every time we run an annual deficit, we must borrow, which in turn increases the total national debt. To understand if this debt is manageable, we look at the debt to GDP ratio, which compares what we owe to our total economic output. The federal debt is essentially the sum of the all past annual budget deficit and surpluses. Interestingly, the running a deficit does not always mean our debt to GDP ratio is rising. During the 1960s and 70s, the government ran small deficit, but because the economy was growing faster than the debt, the ratio actually declined. However, this trend reversed during the 2008 to 2009 recessions, where the ratio rose sharply. After leveling off for a few years, it spiked again to historic levels in 2020 due to pandemic. When the US Treasury needs to cover the gap between spending and taxes, it must sell securities to borrow the difference. These come in three main securities, based on their length. Treasury bills or T-bills are for short-term borrowing, ranging from a few days to 52 weeks. Treasury notes or T-notes are for medium term, lasting 2 years to 10 years. Treasury bonds or T-bonds are for long-term borrowing, spanning 20 to 30 years. So, who is lending this money? The lenders include domestic investors like individual citizens and pension funds, as well as international investors such as the foreign central banks. We also have the governmental debt, where the government borrows from its own trust funds, like Social Securities. And finally, the Federal Reserve also holds a large portion of this debt. Thank you for watching.